Hi, everyone. Thank you so much for joining us today for this presentation on basic tax issues for low-income clients. We're going to give it just another minute or so for people to join, and then we'll get started. I think we can start, and then people can continue to join. Hi, everyone. My name is Shloka Krishnan. I am the Development and Communications Manager at the AIDS Legal Referral Panel. Thank you so much for joining us today for this presentation from Bianca Co. of Hanson Bridgett on basic tax issues for low-income clients. So our agenda for today, I'm going to provide a little bit of an overview to ALRP and our panel of pro bono attorneys, and then we'll move into the training from Bianca, and we'll have time for Q&A throughout and then also at the end. When you leave the Zoom, you will be redirected to an evaluation form. Please make sure to submit that form because that's what will prompt us to send out a certificate for CLE credit. That process is not automated, so give us a few days to do it. They'll come from our pro bono panel manager, Jake Creasy, and he's actually out sick this week, so he'll get them to you soon, but not immediately. Some quick housekeeping. The training's being recorded, and we'll share the recording out afterwards in the next few days. Participants are muted, but you can either enter questions through the Q&A function, or if for some reason that doesn't work for you, you can also raise your hand and we can unmute you on our end. As I mentioned, you'll receive the link to the evaluation form. It'll pop up when you leave the Zoom, and you'll also get the link in an automated email tomorrow as well, in case you're not able to access it immediately for some reason. Everyone should have received the presentation materials already, but let me know if you didn't, and I can send them your way. So just some background on ALRP. ALRP was founded in 1983, and we just marked our 40th anniversary last year. Our mission is to advance and protect the rights, dignity, and health of people living with HIV or AIDS in the Bay Area. When we were founded, really what we were was a scrappy group of volunteer lawyers who got together to draft emergency wills for people who were dying very quickly. We're really grateful that the landscape has changed since that time, but there are still real challenges associated with managing a chronic health condition that can be exacerbated by stress, that can be exacerbated by housing instability, by immigration status, by any number of things that complicate a person's life. So that is what we are working to address these days by connecting people living with HIV in the Bay Area to the full array of civil legal services. We do that in two ways. So first, we have a team of in-house staff attorneys. Many of those staff attorneys are working in eviction defense. We have a pretty robust in-house housing program. And we also have a couple of other areas that we can handle in-house. But in addition to that, we also have a panel of several hundred volunteer attorneys who are willing to accept referrals from us. And so that is how a lot of our clients are able to receive the comprehensive services that they need. Our panel attorneys' expertise really sort of like ranges from, family law to bankruptcy to medical malpractice or any number of things. And they play a really key role in providing the low-cost legal services that can make an enormous difference in our clients' lives. So just a few numbers. Since 1983, ALRP has handled nearly 100,000 legal matters for people living with HIV in the San Francisco Bay. These days, about 80% of our clients are living on an income of $30,000 or less. So again, the free and low-cost legal services that our panel attorneys provide are really, really critical. And and you can see more on our website if you're interested in some more numbers about what we've accomplished and who we serve. So just a quick pitch. Our goal in offering these trainings is twofold. So first, we really are just, invested in increasing the capacity of attorneys who are, supporting our community. But second is that we are hoping to recruit new talent to join our panel. So if you're not yet on the panel, we hope you will consider joining. I think many of the people who are involved with us will attest that it's a meaningful and positive experience for them, and a way for them to give back to the community. It's also as small or large a commitment as you would like it to be. So we generally ask that panel attorneys accept 2 referrals a year, but you can always, say no. And of course, you can always say yes and invest as much time into the process as you would like. How it works is a client comes to us, we do a thorough intake, sort of identify whether they would be best served in-house or through a referral. If it's a referral, we do a bit of matchmaking in our database to find an attorney who, has relevant experience in the right practice areas, who maybe has language skills that are relevant if the client's not a native English speaker, and so on. And then we'll sort of reach out to you with a bit of information about the case, see if you're willing to consult with the client. If you say yes, we'll connect the 2 of you, and you can take it from there. All of our panel attorneys are covered by our malpractice insurance. We also have the ability to connect you with other attorneys on our panel for mentorship support, if that would be helpful. And yeah, I think generally people involved it's a process that works out well for everyone involved, and we would love to have you on board if you're interested. So please reach out. There is more information on our website at alrp.org/getinvolved/pro bono opportunities. And our pro bono panel manager, who was CC'd on the email I sent out earlier today with the materials, would also love to hear from you and answer any questions. If for any reason you can't join the panel but still want to support ALRP, or if you are on the panel and want to support ALRP, you can always make a donation at alrp.org/donate. All of the legal services that we provide in-house through our staff attorneys are completely free to clients. So donations from people like you are how we make that happen. I should also mention that our annual reception is coming up a week from today. It'll be from 5:30 to 8:30 on Thursday, October 24th at the Grand in San Francisco. More information on that is also on our website at alrp.org/events. And it would be great to see you all there if anyone is interested in coming and buying a ticket and supporting ALRP. We have a really exciting lineup of honorees this year. Final thank you to all of our co-sponsors who helped spread the word about this series. Really grateful for their partnership, and for I'm sure many of people on the call who are new to ALRP heard about us through them. So thank you. All right, that is the end of my little narrative. So Bianca Ko, who we have with us here today, is an associate at Hanson Bridgett in San Francisco. Her main focus in her practice is in international tax. She also has extensive experience with family wealth planning, qualified small business stock, California property taxes, and nonprofit organizations. And she has also been a panel attorney with ALRP and accepted referrals from us. And we've had great feedback from clients, and we're really grateful for all of her support. So thank you, Bianca, and I will turn it over to you from here.
Okay, I think this is the right screen. Okay, thank you so much, Loka, for the introduction. I can concur with the sentiment of the being a panel attorney. I don't think I'm a panel attorney, but Hanson Bridgett is a partner, and we take a lot of referrals from ALRP, and it's always been a great experience. So yeah, like just following up on that pitch. Thank you for coming to my presentation about basic tax issues for low-income clients. I did this presentation 2 years ago to, I think, 20 people. So it's looking at the number of participants right now is that's pretty good. Yeah, so again, my name is Bianca Ko. I'm an associate at Hanson Bridgett. I've been here for about 2.5 years now. As Loka said, my expertise is in international tax and a little bit of estate planning. I also do qualified small business stock planning, and I really enjoy like doing trusts and wills and and looking at them from an international tax perspective. So if anybody really wants to talk like foreign non-grantor trusts, please let me know. So that's enough about me. Let's go on to the next slide. So this is our outline for today. And I think Silke and I talked about how we're going to do questions. So after every main bullet point on this outline, I will ask Silke, who's monitoring the Q&A, to see if there are any questions. So yeah, this is the outline. First, we're going to talk about filing requirements versus like just it's good for a person to file. And then we're going to talk about filing status. The second big bullet point is how to file, which really means like what kinds of income might be on a person's tax return, and also and also the major tax credits that low-income clients should be aware of. And then the third big thing is how to pay outstanding tax debts. So that's going to be a little bit on the tax collection process, something on the payment plan, and finally the offer in compromise, which I find that a lot of clients ask about, and yeah, so that's the outline for today. So our first topic is who must file and who should file. So we're going to go through the difference between who must file and who should file. In broad strokes, the people who must file are people who earn over a certain amount or they owe taxes. People who should file are the people who are typically due a refund. So they might not have earned over a certain amount, but they still have a W-2 from their employer, and their employer did withhold taxes, and they should file for a credit, or they qualify for a refundable tax credit, which is basically what it says on the tin. If you even if you earn very, very little, and you don't pay taxes, like you earn under the minimum requirement to pay taxes, you might have a refundable tax credit. You might be eligible for a refundable tax credit, so you actually get money back. So things like the EIC, there's a refundable portion of the child tax credit. Those are the types of refundable tax credits that I'm talking about. And we also have some of them I think there are also some refundable tax credits in California, which we'll cover later. So as I said, the people who must file are typically people who earn over a certain amount. This is the table with the certain amounts that we're talking about. So it's about like 1,400 for people who are single, and then we have all the different filing statuses here. Also, but we should probably note that these numbers are for people who are W-2 employees. So if you work for a company and they send you a W-2 in January, those are the numbers that you're looking at. If your client is self-employed, so if they drive for a ride-sharing service, or if they babysit, and they earn more than $400 in the year, then they must file a return. In some cases, you have to file for somebody else. And for low-income clients, that's probably for a decedent. So you have to file for a decedent if the taxpayer died with filing requirements, and you are the surviving spouse, executor, administrator, or legal representative. I would also, at this point, think about filing a Form 56, which is a notice of fiduciary relationship. Those are forms that we usually file for my clients who have a trust, and they have a living trust, and the trustee and the grantor dies, and then there's a change in trustee, and that's usually when I file a new notice for a fiduciary relationship. I don't think people do this normally. It's a form that's very often overlooked. But I think that's something that maybe people should be aware of. And yeah, I think that's all I have. Oh, there was last time when I did this presentation, there was a question about filing for a decedent if you're not the surviving spouse or executor, but you have like a joint tenancy bank account with that decedent. So in that case, like absent of your relationship with the decedent, you don't actually have a filing requirement, but you should be aware that if nobody files taxes for the decedent, the IRS could place a lien on that joint tenancy account. So yeah. So again, people who should file, so even if you do not have a requirement to file, you should file a federal income tax return to get money back. If you had federal income tax withheld or made estimated tax payments. So usually that's someone who owns their own business. So the ride sharing app that I mentioned before, or like an Airbnb like situation. Although that's at that point, but if your client has an Airbnb, that's probably wiser to put in an LLC, and that's a conversation for another day. And yeah, or you qualify for certain tax credits, so we can cover that later. When I started in law school, and like took my first tax class, I found this table incredibly helpful, so I include it on this slide. So this is the steps to calculating your federal income tax. You have your gross income, you have your adjustments to income. If you've if you see a tax return, you know what this is. You have your adjustments to income, so like your educator expenses, your IRA deductions, your student loan interest deductions, anything that's yeah, so that's that. And so after your adjustments to income, that's how you get your AGI, your adjusted gross income. Your AGI is very important. Because it's used for means tests. So the one that springs to mind for everybody, I'm sure, is probably the stimulus payments back in COVID. That was your your AGI was used to calculate, your AGI in previous years was used to calculate for whether you were eligible for the stimulus payments. And then you have your deductions. So those can be standard or itemized. I think the majority of people use the standard deduction, especially after 2017. And then you have after you take that, you have your taxable income. From that, you calculate your tax liability. You take any credits you have. You deduct any taxes that were previously withheld either by your employer or just by you paying your quarterly taxes. And then you have your taxes owed in the or your refund amount. So this is your filing status. These are your filing statuses. You've got single, you've got married filing jointly, you've got married filing separately, head of household, qualifying widow. Seems very, this seems straightforward. So we're going to cover head of household, which is the one that trips people up a lot, myself included. I also wanted to add that for married filing jointly, oh, I'm sorry, I didn't. So whether you're single or married depends on your status as of the last day of the tax year, or at the time that your spouse died. So say you were married, say like a client was married in 2024, their spouse died in March. The surviving spouse can still file married filing jointly for 2024, unless the surviving spouse remarried within the year. Then obviously they either file married filing jointly or married filing separately with their current spouse, and then they file a married filing separately return for their deceased spouse in 2024. Yeah. Okay, we have one question so far. All right, so we're going to talk briefly about the head of household status. To qualify as head of household status, you must be either unmarried or considered unmarried. So you are considered unmarried if you file a separate return, you paid more than half the cost of keeping up your home for the year, your spouse did not live in your home during the last 6 months of the year, your home was a main home of your child, stepchild, or foster child for more than half the year, and you're able to claim the child as a dependent. Your child can be claimed as a dependent if they're your child and they are either under age 19, they are a student under age 24, or any age if they are permanently and totally disabled. They lived with you for more than half the year, and they did not provide more than half of his or her own support for the year. The qualifying child is also so like did live with you for more than half the year does not include like temporary leaves. So if you have a child who is a student under the age of 24 and they were in college, they're still, as long as you like provided for more than half of their support for the year, they're still considered as at the time that they spend at college is still considered to be their time living with you. That does not count against you. And yeah, and also the other thing is that a dependent can only be claimed once. If you, so like you and your and the child's other parent cannot both claim that child as a dependent. So we have examples. And Sloka, I think if you could please
Yeah, I
put
can
in
launch the poll.
yeah, the polls. So the first one, Janet has never been married, lives by herself, and has paid all the expenses of keeping her home for herself and no one else. She earned $13,500 at her job as an employee in 2024. Which of the following are true? Janet must file a tax return, and Janet should file a return.
Okay, I'm gonna end this and share the results because it looks like a number of people have answered.
Ooh, okay, so we have 46 to 54, interesting. Yeah, so I think that Janet is just under the 13,850 for being required to file a tax return. But I think most people are right. She should probably file a tax return anyway for certain tax credits that we will talk about later. The second question, June of 2024, Donna took her daughter Eleanor and moved out of the apartment she shared with her husband. Donna and her husband are not divorced or legally separated. Since June, Donna has paid all the expenses of keeping up a home for herself. She refuses to file a joint return with her husband. Which filing status should Donna use? Okay, so this is good. I think so I think everybody was correct. Donna cannot file a single because she is still married at the end of 2024. So the votes are split between head of household and married filing separately. So she could file married filing separately. But I would also look at filing for head of household. And this is because head of household so sorry. So she qualifies for head of household, and she's able to, it seems that she is able to claim the child as a dependent, and the rates for head of household are the thresholds for head of household are a little bit higher for the tax brackets. So I think I think I would advise her to file head of household. Are there any questions so far? I see one in the Q&A. I'm going to go ahead and read that. How does a person who is not a relative but who is on a beneficiary who is on a beneficiary on a decedent's bank account obtain a death certificate to present to the bank? This is interesting. This is more of a probate question. But yeah, this is definitely a probate question. I believe that you can request a decedent's request a decedent's death certificate at like at a county court, the way you might yeah, like the way that you can request like a marriage certificate and things like that. So yeah, I think this is probably a probate question. I think in California you can probably request it from the county court or from like the courthouse, depending on the county like where the decedent passed. Somebody also asked, this is 6 months without. Thank you, Beth. So there are restrictions on who can request a certified death certificate. That's out of my wheelhouse, unfortunately. Is it 6 months without living with the spouse strictly enforced? I think that would be an audit issue. So if you have so like when the IRS is auditing, you would probably have to provide proof that you did not of like where you lived. Like you would have to provide a proof of address, so like your lease or something like that. So it's kind of like all the other all the other tax laws where yeah, like it's you don't present the lease with your tax return, but you should probably have a record of it so that in the event of an audit, you can answer these questions. Okay, I think those are the questions that we have. So I think we can move on. So how to file, and this is kind of a misnomer. It really should be like income and credits. That's my bad. So I think a lot of low-income clients are looking at like the taxability of Social Security. There is the main takeaway that I want people to get from this is don't try to do this yourself. You should receive the client should receive a form SSA 1099 showing the total Social Security benefits paid. In general, there's a threshold. So if 50% of your Social Security benefits and your gross income added together is 25,000 or less, then your Social Security benefits are not taxed. So yeah, that's all I have for this slide. We also have taxability of unemployment. Unemployment compensation is taxed. This includes state unemployment insurance benefits, benefits paid by a state or the District of Columbia from the Federal Unemployment Trust Fund, and disability benefits paid as a substitute for unemployment compensation. In general, taxpayers should consider having taxes withheld from unemployment compensation. And this option should be available when you're filing for unemployment, but there is a form if it's not part of the application. I also added a cancellation of debt income slide. In general, cancellation of debt results in income. This makes sense if this makes sense, like just from if I pay you $1,000 and you're supposed to pay it back to me, and you end up not paying it back and I forgive the debt, then that looks a lot like income. Cancellation of debt income may occur if a creditor can't collect or gives up on collecting the amount the taxpayer is obligated to pay. The taxpayer in that case may receive a Form 1099-C showing the amount canceled and the date of cancellation. There are certain exemptions to cancellation of debt income. So amounts canceled as gifts, bequests, devices, or inheritances. Those are gifts, bequests, devices, or inheritances. Those are subject to gift and estate tax, not income tax. There are certain qualified student loans for certain qualified student loan forgiveness is not considered cancellation of debt income. Certain student loan discharges, certain student loan repayment assistance programs, canceled debt that would be deductible if the taxpayer had paid it. That feels like common sense. That feels very intuitive. And then qualified purchase price reduction given by the seller of property to the buyer. That's just a discount. That's not considered cancellation of debt income. There are certain exclusions from gross income, even if it is cancellation of debt income. So debt canceled in a Title 11 case, debt canceled to the extent that the taxpayer is insolvent, cancellation of qualified farm indebtedness, real property business indebtedness, qualified principal residence indebtedness that is discharged before January 1st, 2026. And now we move on to credits. The earned income credit is probably the most important tax credit to low-income taxpayers. It is a refundable credit. It is available for taxpayers who have earned income and meet certain income limits. So earned income in this case means wages, salaries, tips, taxable employee pay, net earnings from self-employment, gross income received as statutory employee. So not investment income, not like interest income. And then there is a link up there to see for like a tax assistance to see if you are eligible for the EIC. So eligibility requirements, there are AGI limits, and the taxpayer has to have a valid social security number, which makes sense because they would have a valid social security number if they earned wages in the United States. Joint return if married, so no like married filing separately, with limited exceptions. US citizen or resident alien all year, that ties back to the valid social security number. They cannot file the form 2555, which would be used to claim a foreign earned income exclusion. Your investment income is 11,600 or less. That might need to be updated. And then there's also earned income limits. So the earned income credit is available regardless of whether a taxpayer has a child. So if you have a child, your child meets the relationship, age, residency, and joint return tests. Your qualifying child cannot be used by more than one person to claim the EIC, and you cannot be a qualifying child of another person. If you do not have a qualifying child, you must be at least age 19. If you're a student, you must be at least age 24. You cannot be the dependent of another person. You cannot have a qualifying child. You gotta be a qualifying child of another taxpayer, and you must have lived in the United States for more than half of the year. We now move on to the child tax credit. The child tax credit is claimed by families with qualifying children. It's a refundable credit. It's up to $2,000 for each qualifying child for 2024. Qualifying children are under 18 at the end of the year and properly claimed as a dependent on your tax return. The child tax credit starts phasing out at a modified AGI of 75,000 for single taxpayers, and then about 113,000 for head of household taxpayers, and 150,000 for married filing jointly or qualified widows and widowers. So those were the federal tax credits that we wanted to be aware of. These are and now we're moving on to the California tax credits. The California earned income tax credits are for taxpayers who have earned income and meet certain income requirements. The credit is up to $7,430 for 2023. And these are the eligibility requirements. The one thing that I want to point out is that for a Cal EITC, you don't need a social security number. You need it, and you can claim it with an individual taxpayer identification number, or an ITIN. So it's important that the California EITC doesn't have to be claimed by a US citizen or permanent resident. You can be a resident alien and still qualify. So this would be someone who is the spouse of someone who is here on a visa, maybe, and their own visa doesn't allow them to work in the United States. That would be somebody who has an ITIN. So yeah. I also wanted everybody to be aware of the California non-refundable renters credit. This is the tax credit for taxpayers who paid rent for at least half the year. There is a California income cutoff. The credit is $60 for somebody who is single or married filing separately, or $120 for head of household if married filing jointly, widower taxpayers. So the eligibility requirements are you paid rent in California for at least half the year. The property was not tax exempt. Your California income was, I think this might have to be updated, about 50,000 or less. You did not live with someone who can claim you as a dependent. And then you and your spouse were not given a property tax exemption during the tax year. So we're going to have some examples. So Silka, please push the poll. So we have two of these for 2024, Val had the following income. Which of these items may be taxable?
I'm gonna share the screen now.
Okay, so we have 10,000 of Social Security benefits. So like I said, there's a website for this and we don't necessarily need to do it. But if the sum of 50% of Social Security benefits and the gross income is 25,000 or less, then the Social Security benefits are not taxable. So this would be 5 plus 16, that's 21, plus 10, that's 31. So the gross, so that sum is more than 25,000, and so the Social Security benefits would be taxable. $16,000 of wages is taxable, and then 10,000 of unemployment benefits are also taxable. I remember that unemployment compensation is taxed. So yeah, well done. Okay, the next one. Jason and Stephen, US citizens and California residents, have one child, Todd, who is 19. Jason and Stephen each have earned income. They live together in an apartment which they rent. Which tax credits might they be eligible for? Okay, so let's walk through them one by one. Earned income credit, we didn't put how much they earn, but they each have earned income, and so they probably and so they might be eligible for earned income credit. Child tax credit. Your qualifying child is under 18 at the end of the year, and so and Todd here is 19, so they're probably not eligible for that. California earned income tax credit, like the earned income credit, and then which they might be eligible for, and then California non-refundable renters credit. They rent in an apartment in California, so they might be eligible for that. So yeah, Okay, cool. We have one question, which is for these credits, for which do you have to file your taxes on time? So I actually don't know. I might have to I will probably, I will do some research and get back to you on that. That's an interesting question. Because I've always approached the low income taxpayer, and they're filing their tax returns as as like a VITA volunteer or somebody who is like just, getting, or like someone who is getting their return filed on time. Um, I believe that, I've seen like EIC that was claimed after the, for like a previous year. But yeah, I will take a look and get back to you on that. Okay. So we have our final bit, which is the tax collections. Here's an overview of the tax collection process. If you owe taxes, the IRS will send you a bill. The interest and penalties accrue until the bill is paid. If you do not pay the first bill, the IRS will send at least one more bill. If you do not pay the subsequent bills, the IRS may begin the collection process. So the collection process, there are three types. So it's the federal tax lien, but there are three devices for the IRS to enforce the federal tax lien, which is the administrative levy, the administrative seizure, and the judicial collection. And so we have the funny thing about this is that the Internal Revenue Memorandum, which the IRS uses which the IRS uses to like train its employees, actually states that there's no like functional difference between the levy and seizure. Judicial collection means taking the taxpayer to court. The taxpayer has certain remedies though, such as the collections due process hearing. You have a collections due process hearing, and the important thing is to not miss it. Yeah, because it could, the administrative judge could say like, hey, like don't go forward with this lien yet because the taxpayer showed up to their due process hearing, and there are reasons why they haven't paid it yet. I wanted to touch on the installment agreement or payment plan. The IRS allows the taxpayer to make smaller periodic payments over time if you cannot make the full payment at once. There are two kinds. There is the short term and the long term. The taxpayer cannot enroll in this program until they have filed all required tax returns. And here's how to apply. It is possible to change an existing payment plan. So if the taxpayer falls behind, it is important that they make an attempt to change it so that the IRS doesn't go back to collections. The IRS may ask the taxpayer to complete a collection information statement and provide a proof of financial status. And interest and penalties are still charged until the balance is paid in full. This is the offer in compromise slide. The IRS may accept an offer in compromise. This is for if your client has a $10,000 tax debt that they cannot pay. They can apply for an offer in compromise and say, all right, like I have $2,000, can I please settle this tax debt with the IRS? And this is an attractive option for a lot of taxpayers. But there are eligibility requirements, and the IRS does take a while to approve it or deny it. So eligibility requirements, they must file all tax returns they are legally required to file. They must have received a bill for at least one tax debt included on the offer. They must make all required estimated tax payments for the current year. This is the one that that trips up a lot of taxpayers because a lot of the time they're probably somebody who drives for a rideshare program or something like that, and they haven't made all of their estimated tax payments. So that's the one requirement that a lot of taxpayers don't make. And the last one is that they are not in a bankruptcy proceeding or undergoing an audit. There is an entire booklet which is used for the application, and they apply by mail. So there's the form 656. There's the form 443A for which is a collection information statement, and they need to put together supporting documentation. The application fee is $205 unless you meet the low income certification guideline, plus initial offer payment. The low income certification guidelines I thought I had it written down somewhere. But yeah, like it's in the booklet. Okay, I think that's it. I have one question here, which is, can you request an offer and compromise at some point during the existent payment plan? I believe that you can, but the chances of, unless it's due to like a change in circumstances, if you already have a payment plan with the IRS is not really likely to determine, like, you already have a payment plan, you've told the IRS how you're going to pay it. And so it's unlikely that the IRS will look at somebody with a payment plan and say, oh, like, yeah, they really cannot pay their tax debt, when you're like, okay, like, this is how I'm going to pay it. So if there is a change in circumstance, I would probably see if there is a change in payment plan that you can make, that the client can make, and then if the change in circumstance is really, really drastic, then I would probably push for an offer and compromise. So there was also somebody earlier who copied the information for claiming the IC for prior years. That makes sense to me, that you have 3 years to file and claim a refund. So it's really your statute of limitations for settling for claiming a refund is the deadline for your tax return. So I think that's all I have. If anybody has any other questions, please let me know. My email is it's in the beginning of the materials, and I'd be happy to answer any questions as well.
Thanks,
Yeah,
Bianca.
thank you for listening to me drone on about taxes today.
Yeah, we're scheduled until 1:15, so if people have questions, we'll give you a few more minutes to, think and ponder and type them out. And then if nothing's showing up, I think we can go ahead and close this out. But I'll give folks a little while to enter any questions they may have. It looks like we have one question from Martha.
How long does it take to have the federal tax lien lifted after the taxpayer satisfies the debt? That is a county by county, and that is a very like individual case, facts and circumstances question. So like if the lien is on a real property, that's, you probably have to, oh no, sorry, the federal tax lien. I don't know. I've never had a federal tax lien lifted, like after because I've never worked with a taxpayer who had a lien already. Usually we would have the collections due process hearing, and then we would kind of settle with the IRS based on that. So yeah, I'm really not sure. But I have looked up like how to get a federal tax lien lifted before, and I can send that information. I just don't have like personal experience with it. Can I recommend a practice guide or a CEB? Practice guides, actually, the IRS has publications that are incredibly useful, especially for low-income taxpayers. Because they're geared for like kind of pro se taxpayers who cannot hire an attorney, like pro bono attorneys notwithstanding. So yeah, like it's that's usually my go-to is like IRS publications. Does the FTB do offering compromises? Yes, they do. How long do they take? I do not know. It's just really hard in general. Like I don't even know how long like the IRS OICs take. It's just it's like really like any it's really like any number of like months, I would say. Is there a mentor lawyer or known very successful go-to lawyer to associate for OICs? I don't know one. If anybody does know one, please let me know. So is there a benefit of filing for head of household compared to single or married? Yes, that is usually, I have a lot of clients coming from tax preparers, notarias that are filed head of household who I don't believe qualified for that category and wonder if it's being done to get them larger refunds they shouldn't qualify for. Yes, it is. The thresholds for the tax brackets are slightly higher for a head of household. So the same person, the same income would be taxed at different rates for head of household versus single or married filing separately. And Beth, again, thank you. Yeah, okay, so the IRS they say that the IRS releases your lien within 30 days after you've paid your tax debt. So that's useful information. I also wanted to point out that there is a taxpayer advocacy service that is separate from the IRS. I have used them a couple times. So if you feel that the IRS is just not responsive and they're not doing anything to kind of communicate with your client, and it's really frustrating. The taxpayer advocacy service is separate from the IRS, but they work on a lot of clients with them. And that's been a really, really helpful resource for me.
Right, it looks like that's everything in the Q&A. So I think we can, James says they reviews them as well and also recommends them. But yeah, I think we can wrap things up. Thank you so much for presenting with us today. And thanks to everyone who joined us. Again, when you leave the Zoom, you'll get an evaluation form link, so fill that out. And we'll be in touch probably next week with your certificates of attendance for CLE credit. And then, thanks, Martha. And then, yeah, let us know if you'd like to join LRP as a panel attorney. Come to our annual reception next Thursday. Hope to see you all around, and have a great afternoon.
Thank you.